Managed Personal Finance Book, Chapter 18, Luggage, Etiquette, and Earnings per Share. This is Ken Boyd with the Accounting Accidentally site. So, an author's note, I'm posting a text version of the entire book on Substack and video versions here on YouTube. You can email me for details of the fifth book's publishing date in late 24, early 25. So, a heavyset man with a limp was trying to drag a heavy bag off the baggage carousel. We've all seen this. He started to lose his balance, so I grabbed the suitcase and pulled it off for him. Now, I'm no hero, but it did remind me of something. There are dozens of ways financial analysts evaluate stocks. If you watch the media, you may feel bombarded by the investment terms you see, similar to how the fast luggage moves on the carousel. It can be overwhelming. So it's important to leave much of the analysis to an investment advisor, a point I made throughout the book. However, I think every investor should understand the concept of earnings per share because this is the basis for many stock valuations. Simply put, firms that consistently generate earnings are seen as more valuable than businesses that aren't profitable each year. So, earnings per share in the Play-Doh analogy, you may have had Play-Doh and a Play-Doh machine as a kid. So the way the machine works is you put dough in the toy, you turn the handle, and the dough comes out in different shapes on the other end, like a star, a triangle, etc. That's like generating company earnings. And for our discussion, we'll say that earnings, net income, and profit all mean the same thing. So here's how the machine works. You put dough in the machine. That's the material and labor costs to make a product or service. Turning the handle means creating the product or service. And finally, the dough that comes out is the profit on the sale, comes out the other end. Businesses turn the crank on the Play-Doh machine every month to produce profits. So now let's go to the formula. The formula for earnings per share, or EPS, is the net income available to common stock divided by the average shares of common stock outstanding. In other words, how much did the company earn on each share of common stock? That's what we're measuring. Now, not all net income may be available to common shareholders. Firms that issue preferred stock, in addition to common stock, may set aside net income to pay a preferred dividend that is paid before the common shareholders are paid a dividend, hence the name preferred stock. They get their dividend first if one is declared. That said, let's assume that Premier Manufacturing earns $5 million and that the average number of common stock shares is 2 million. So earnings per share is $5 million divided by 2 million shares, or 250 a share. There are more shares of common stock outstanding. If the company issues more stock, the earnings per share will be lower. That's because you're spreading the same amount of profit, $5 billion, over more shares. So is 250 a good, bad, or average return? Well, the answer can be found in earnings yield. This is where we compare it to the stock price. So we look at earnings per share divided by the market price of the common stock. So if Premier's common stock price is $60, the earnings yield is 250 divided by $60, or 4.2% with rounding. Your goal as an investor, you'd like to get a higher earnings yield compared to the average yield for most stocks. A higher earnings yield would be more valuable and attractive. Here's the challenge of investing when markets are at an all-time high. When the price you pay for stock goes up and the earnings stay the same, the earnings yield is lower. Essentially, you're paying a higher amount for each dollar of revenue, for each dollar of earnings or profit the company makes. So higher prices, same amount of earnings, the earnings yield goes down. So keep this discussion in mind when you hear the term earnings per share. That's as far as we'll get right now. Remember that you can find all the content at the Accounting Accidentally Substack page. Thanks.